There are 5 bills sitting on your kitchen table right now that you do not have to pay. You are paying them because nobody told you that you are legally exempt. Not partially exempt. Not exempt under certain conditions. Legally exempt. I want you to picture that stack of mail on the counter. The one with the property tax statement and the Medicare notice, and the bill from the tax preparer you have used for the last 15 years. Somewhere in that stack is money that is leaving your bank account every single month that does not have to leave. These are not loopholes. These are not gray areas. These are not clever moves that some accountant dreamed up. They are exemptions, waivers, and programs that the federal government and your state government created on purpose, specifically for people in your exact situation. Retirees, seniors, people over 62 or 65 who qualify automatically based on nothing more than their age, their income, or how they file their taxes. The only reason you are still paying these bills is that nobody told you to stop. So today, I'm going to show you all 5. I'm going to tell you exactly which bill to stop paying, exactly which form to file, or which office to call, and exactly how much money you will save. Some of these take 5 minutes. Some take 1 phone call. All of them put money back in your pocket starting this year. And to show you how it works in real life, let me introduce you to Dorothy. She is 68, she lives alone in the house she paid off 6 years ago, and right now she is overpaying on these bills by about $1,780 a year. That is money that leaves her account month after month, year after year, that she does not legally owe. Before I go any further, the standard reminder. I am not a lawyer. I am not a CPA. I am not a financial advisor. This video is for educational purposes only and is not tax, legal, or financial advice. Talk to a qualified professional before making any decision about your specific situation. Exemptions and program eligibility vary by state and individual situation. Always confirm your eligibility with your local tax office or a qualified professional before making any changes. My name is Eric, and this is Retirement Plan with Eric. Every week on this channel, I walk through tax rules, Medicare changes, and state program traps in plain English for retirees and pre-retirees over 60. Hit the subscribe button right now and turn on notifications, because this is the kind of money in your pocket information that the offices sending you these bills are never going to volunteer. And before I start, do me one favor. Drop your age in the comments. Just the number. I want to know exactly who is watching this video right now, because the older you are, the more of these 5 bills probably apply to you. So let me tell you about Dorothy. And I want to be clear right up front. Dorothy is a composite, based on the kinds of situations the tax offices and state revenue offices see every day. Not a real person. But her numbers are real numbers, the kind I see all the time. She is 68 years old. She retired 3 years ago after 31 years as a public school teacher. She bought a modest 3-bedroom ranch back in 1997 and paid off the mortgage 6 years ago, so the house is hers free and clear, worth about $350,000 today. Her total income is about $52,000 a year. $22,000 of that is Social Security, $18,000 is her pension from the school district, and $12,000 is what she pulls from her IRA each year. She is careful with money. She clips coupons. She keeps the thermostat at 68 in the winter and wears a sweater. She drives a 12-year-old car. She has never once been late on a bill in her life. And here is the thing that should bother you. Dorothy is overpaying on her bills right now by about $1,780 a year. That is about $148 a month leaving her bank account, month after month, that she does not legally owe. Over the 3 years since she retired, she has already overpaid by more than $5,000. Money she could have used for groceries, for her medications, for a plane ticket to see her grandchildren. Gone, because nobody ever told her she was exempt. So let me walk you through every one of these bills, exactly the way I would if Dorothy were sitting across the kitchen table from me. Bill number 1. Bill number 1. Your property tax. This is the big one, and it is the one that makes me the most frustrated on your behalf. Because in most cases, the money is just sitting there, waiting for you to claim it. Here is how this bill works and why you are paying it. When you were working, nobody automatically lowered your property taxes. And when you turned 65, the county did not send you a letter. Almost every state in the country offers some kind of property tax reduction for senior homeowners. They go by different names: a senior homestead exemption, a senior assessment freeze, a school tax exemption, but the result is the same. They reduce the taxable value of your home, which directly lowers your annual property tax bill. And in many places, they freeze it so it can never climb again. But here's the catch that costs people thousands of dollars. In almost every case, you have to apply. The county does not do it for you. The county is perfectly happy to keep collecting the full amount until the day you walk in and ask. Let me show you how this looks in real numbers with Dorothy. Her home is worth about $350,000. Her county taxes property at a rate of about 1.8%. So without any exemptions, her annual property tax bill comes to about $6,300 a year. That is more than $500 a month just to keep living in the house she already paid off. Now, her state offers a senior exemption that knocks $60,000 off the taxable value of her home for owners who are 65 and older. If Dorothy had applied, her taxable value would drop from $350,000 to $290,000, and at that same 1.8% rate, her new bill would come to about $5,220. That is a savings of $1,080 every single year for the rest of her life, just for filling out a one-page form. But Dorothy never applied, because nobody told her to. Now look at how generous some of these state programs actually are. Because this is where it gets interesting, and this is why you need to check your own state today. In Texas, homeowners who are 65 and older get an additional $60,000 exemption off their home's value just for school district taxes, on top of the general homestead exemption. And this is the part people miss. The year you turn 65, your school taxes get frozen at a ceiling. According to the Texas Comptroller's Office, your school district taxes cannot go above that amount as long as you own and live in the home, even if your home's value doubles. The form for that is Texas Comptroller Form 5114, the Residence Homestead Exemption Application. In Georgia, the Department of Revenue says homeowners 62 and older can claim an additional $10,000 exemption from school taxes if they meet the income test, and many counties layer on even bigger breaks. Some metro Atlanta counties exempt seniors from 100% of their school taxes. In New York, the Enhanced Star exemption is available to homeowners 65 and older, and the New York State Department of Taxation and Finance set the income limit for the 2026 benefit at $110,750 based on your 2024 income. So here is your action step for Bill number 1. Call your county assessor's office, not the tax collector, the assessor, and say these exact words. I am over 65 and I own my home. What senior property tax exemptions am I eligible for? Then ask one more question. Do you accept retroactive applications for prior years? Some places do. Bring a photo ID and a recent property tax statement. For Dorothy, that one phone call and that one form is worth $1,080 a year. Bill number 2. Bill number 2. The estimated tax underpayment penalty. This is a small bill compared to your property tax, but it is the one that makes me angriest, because it is a penalty you get charged for a mistake that retirement itself caused. And there is a waiver written into the tax code specifically to forgive it. Here is what happens. When you had a job, your taxes were withheld automatically from every paycheck. You never had to think about it. The moment you retired, that automatic system stopped, and nobody explained what was supposed to replace it. So in your first year or two of retirement, you might not have paid enough in throughout the year, and the IRS hits you with an underpayment penalty. For Dorothy, that penalty was about $400 in her first year of retirement. Now here is the part almost nobody knows, and I want you to type yes or no in the comments right now. Did you know the IRS has a penalty waiver specifically for retirees? Type yes or no. I guarantee most of you did not know this existed. The IRS instructions for Form 2210 say, in plain language, that the underpayment penalty will be waived if you retired after reaching age 62 or became disabled in the current or prior tax year, and the underpayment was due to reasonable cause and not willful neglect. That is it. You retired, you are over 62, you did not do it on purpose. You check a box in Part 2 of Form 2210, attach a short statement and your retirement date, and the penalty goes away. Dorothy's $400 gone if she had checked that box. And going forward, here is how you stay out of penalty territory entirely. The IRS has what is called a safe harbor. According to the agency's own guidance, you avoid the penalty if you pay in at least 100% of last year's total tax through withholding and payments, or 110% if your income was over $150,000. The simplest way to do that without writing quarterly checks is Form W-4V, the voluntary withholding request. You hand it to the Social Security Administration, and they will withhold 7, 10, 12, or 22% of your Social Security check for federal taxes automatically, the same way your old paycheck used to work. So your action step for Bill number 2. Ask your tax preparer whether Form 2210 was filed with the retiree waiver box for your year of retirement and the year after. If it was not, you can file an amended return. And remember this, you generally have 3 years to claim a refund. If you got hit with this penalty in the last couple of years, that money may still be sittable for. Bill number 3. Bill number 3. State income tax on your retirement income. The reason this one is so easy to fix in some states is the next thing I am going to tell you. There are states that simply do not tax your retirement income at all. And if you live in one of them and you have been paying, you have been giving away money for no reason. Pennsylvania is the cleanest example. The Pennsylvania Department of Revenue does not tax distributions from your pension, your 401k, or your IRA once you have reached retirement age and met the plan's requirements. And Pennsylvania does not tax Social Security at all. That is a flat 3.07% that retirees there simply do not pay on their retirement income. Illinois is a flat tax state that also fully excludes retirement income. Mississippi fully exempts it. Iowa now exempts retirement income for residents 55 and older. And then there are the states that give you a partial exclusion, which is where people leave money on the table without realizing it. In New Jersey, the Division of Taxation says that if you are 62 or older and your total income is $100,000 or less, you can exclude up to $100,000 of pension and retirement income if you are married filing jointly, up to $75,000 if you are single, and up to $50,000 if you are married filing separately. That is enormous. A single retiree in New Jersey pulling $60,000 from a pension and an IRA could pay 0 state tax on it, but only if the exclusion is actually claimed on the return. New York lets taxpayers 59.5 and older exclude $20,000 of retirement income per person. Now here is the part I really want you to sit with. Most states let you file an amended return going back 3 years to recover tax you overpaid. So if you live in a state with an exclusion and your preparer never claimed it, that is not just this year's money. That is potentially 3 years of refunds waiting for you. For Dorothy, Bill number 3 did not apply. Her state does tax retirement income, and there is no exclusion she qualifies for. But I had her write down the rule anyway, because if she ever moves to be closer to her grandchildren, the state she picks could be worth thousands of dollars a year to her. Your action step. Pull your most recent state return, find the line for the retirement income exclusion, and if it is blank in a state that offers one, call your preparer and ask why. Then ask about filing amended returns for the prior 3 years. Bill number 4. Bill number 4. The Medicare IRMAA surcharge. This one is sneaky, because it is calculated on income you may not even earn anymore. IRMAA stands for the Income-Related Monthly Adjustment Amount, and here's how it works. Medicare looks at your income from 2 years ago to set this year's premium. The Centers for Medicare and Medicaid Services confirm that for 2026, the standard Part B premium is $202.90 a month. But if your income from 2024 was above $109,000 for a single filer or $218,000 for a couple, you get charged a surcharge on top. For the first tier, that is an extra $81.20 a month for Part B, plus another $14.50 a month on Part D. That is well over $1,100 a year in surcharges. Now think about who gets caught by this. Somebody who was still earning a good salary 2 years ago, then retired, and whose income has dropped through the floor. But Medicare is still charging them based on that old high salary. That is the trap. And the fix is a form most people have never heard of. Form SSA-44, the Life-Changing Event Request. The Social Security Administration lists 8 qualifying life-changing events, and the very first one most retirees use is work stoppage. Retiring counts. If you stopped working and your income dropped, you file Form SSA-44. You attach proof, a letter from your former employer or a final pay stub, and Social Security recalculates your premium based on what you actually earn now, not what you earned 2 years ago. Here is the one honest caution. A permanent change, like retiring, qualifies, but a one-time spike does not. If you sold a house or did a big Roth conversion 2 years ago, and that is what pushed your income up, that generally does not qualify, because your underlying income has not actually dropped. For Dorothy, Bill 4 did not apply to her either. Her income has always been comfortably under the threshold, but I had her write the form number down and tuck it in a folder, because if she ever takes a large one-time IRA distribution, she will want to understand exactly how the 2-year look-back works. Your action step. If your income has dropped since you retired and you are paying an IRMAA surcharge, file Form SSA-44 with your local Social Security office and ask whether any credit applies for months you have already overpaid. Bill number 5. Bill number 5. Your tax preparation fees. This is the smallest bill on the list, but it is the easiest one to eliminate completely because the alternative is free. Here is what most retirees do not realize. The IRS runs 2 programs that prepare your taxes for you at no charge. The first is VITA, Volunteer Income Tax Assistance, which, according to the IRS, has been operating for over 50 years and is generally available to people who make $67,000 or less. The second is TCE, Tax Counseling for the Elderly, which the IRS says is designed specifically for taxpayers who are 60 years of age and older, specializing in exactly the questions that affect you: Social Security taxation, pension income, required minimum distributions, and IRMAA. These are not amateurs. Every VITA and TCE volunteer has to pass tax law training that meets IRS standards, and every return gets a quality review before it is filed. Dorothy was paying about $300 a year to a national chain to file a return that, frankly, is straightforward. Social Security, a pension, an IRA withdrawal, and the standard deduction. That is $3,000 over 10 years for something she could get done for free. Now, one honest limit. These programs are built for straightforward returns. If you have rental property, business income, multi-state filings, or a large, complicated investment portfolio, you will still want a paid preparer. But for the typical retiree, this is found money. Your action step. Go to the IRS website and search for the VITA locator, or call the locator line at 800-906-9887. When you go, bring a photo ID, your Social Security card, all your income documents, your SSA 1099, your 1099-R, any 1099 INT or DIV, last year's return, and your bank account and routing numbers for direct deposit. That is $300 a year, back in your pocket, every year. And here is the part that should make you genuinely frustrated. None of these programs are new. Property tax exemptions for seniors have existed for decades. The estimated tax penalty waiver for retirees is written right into the Form 2210 instructions and has been there for years. State retirement income exemptions like Pennsylvania's have been law for a very long time. Form SSA-44 has been available ever since income-based Medicare premiums began. And the free tax prep programs are not some pilot project, the IRS says. VITA has been running for over 50 years, and TCE, the program built specifically for seniors, has been around for decades as well. Every single one of these has been sitting there, available, the entire time. And the number of retirees who actually use all 5 of them is almost nobody. Why? Because nobody tells you. There is no orientation day for retirement. There is no welcome packet that lands in your mailbox, saying congratulations on retiring. Here are the 5 bills you can stop paying. The county does not call when you turn 65. The IRS does not flag a recently retired taxpayer with a friendly note about the waiver. The programs exist. The outreach does not. And that gap is exactly where your money has been disappearing. So let me turn all of that into something you can actually do this week. Because indignation does not put money back in your account. Action does. 1. Call your county assessor's office, not the tax collector, and say, I am over 65 and I own my home. What senior property tax exemptions am I eligible for? And do you take retroactive applications? Bring a photo ID and your latest property tax statement. 2. Ask your tax preparer whether Form 2210 was filed with the retiree waiver box for your retirement year and the year after. And if not, ask about an amended return. You generally have 3 years. 3. Pull your most recent state return. Find the retirement income exclusion line, and if you live in a state that offers one and it is blank, call your preparer and ask about amending the last 3 years. 4. If your income dropped after you retired and you are paying an IRMAA surcharge, file Form SSA-44 with your local Social Security office and bring proof of your work stoppage. 5. Find your nearest VITA or TCE site through the IRS website or the locator line at 800-906-9887 and bring your ID, your Social Security card, all your income forms, last year's return, and your bank details. 5 bills, 5 actions, 5 phone calls. Each one takes less than 30 minutes. Combined, for a typical retiree, they could save you somewhere between $1,000 and $3,000 a year, every year, for the rest of your retirement. Now let me show you how Dorothy's week actually went. Because this is the part that turns numbers into real life. On Monday, she called her county assessor and applied for the senior exemption. She brought her driver's license and her property tax statement. The application took about 15 minutes, and her property tax is set to drop by $1,080 starting the next bill. On Tuesday, she called the tax preparer who had handled her first year of retirement and asked the Form 2210 question. It turned out the waiver box had never been checked, so she is filing an amended return to recover that $400 penalty. On Wednesday, she looked at Bill 3, the state retirement income exclusion, and confirmed it did not apply to her in her current state, so she wrote down the rule for the day she might move. On Thursday, she pulled out Form SSA-44, confirmed her income had always been under the IRMAA threshold, so Bill 4 did not apply to her either, and filed the form number away, in case a big IRA withdrawal ever changes that. And on Friday, she found a TCE site at her local library and booked an appointment for tax season, which will save her the $300 she had been paying the chain. Total time spent? A little under 2 hours across 5 days. Total money saved in year 1, including that recovered penalty, about $1,780. And the ongoing savings, every year for the rest of her retirement, about $1,380 a year between the property tax exemption and the free tax prep. Money that now stays in Dorothy's account instead of leaving it. Before I let you go, let me leave you with 5 things to write down. 1. You need to know which exemptions your own state and county actually offer, because the names and the dollar amounts vary, and the only way to know for sure is to ask your assessor directly. 2. You have to file the form before the deadline to claim a refund for a prior year. In most cases, that window is 3 years, and once it closes, that money is gone for good. 3. If you retired after age 62, call your county assessor's office and ask which senior property tax exemptions are available in your county, and do it this year, because some places only apply the exemption going forward from the date you ask. 4. Remember that IRMAA is based on your income from 2 years ago. So if you qualify for a life-changing event recalculation, filing Form SSA-44 sooner rather than later means fewer months of overpaying. 5. Free, expert tax help designed for seniors exists through TCE. If your return is straightforward, there is almost no reason to pay for it. I am not a financial planner, a CPA, or a tax advisor. The programs and thresholds in this video come from the IRS, the Social Security Administration, Medicare, and the state revenue offices I cited as we went. Take this video to your tax professional or your local senior services office and ask them to walk through your specific situation with you. And now, I want to hear from you. Which of the 5 bills are you currently overpaying? Just drop the number in the comments, 1 through 5. That number tells me which one to cover in a full, deep dive video next. If you know someone who keeps wondering why their bills feel so heavy in retirement, send them this video. Most of them are paying for things they do not legally owe. They just have not been told. Subscribe. I make videos like this every week. If this episode helped, hit the like button on the way out. I will see you in the next.